As many of you know, the overnight rate dropped from 3% down to 2.75% this morning. That means that the prime rate has dropped from 5.2% down to 4.95%. So the big challenge that we're having here is these tariffs that have come into the economy. So the Bank of Canada cuts interest rates again, and now is citing that we have a new crisis from tariffs. So if the Canadian economy was already hurting already, and for the past few years we've been fighting inflation, high interest rates, now we have a new crisis on our hands. So the only way to really combat the tariff situation is lowering rates. And a lot of it is because the tariffs are going to have an impact on our economy, and it already has begun to have an impact on our economy. The only real way to stimulate the economy and protect the economy, a big part of it from the Bank of Canada's point of view, is to drop interest rates. So where do we go from here? Now, citing all these details and looking at the history of the prime rate, we know that we capped up around 5% for the overnight rate. We're now down to 2.75%. Where are we headed now? Now, this crisis is what they're calling it, is that the challenge is that these tariffs are going to slow the economy, which is we already have a slower economy at this point in time. But when we turn around and look at it from a different point of view, it could push up inflation, and the cost of goods could drive up as well. So the Bank of Canada is in a very kind of a challenging situation right now. So looking at what economists predict over the next year or so of what's going to happen with the prime rate. So we're currently at 2.75%. And by the end of the year, Q4 2025, BMO is calling for another 0.75% cuts to rates. CIBC calling for half a point more by the end of the year. National Bank, half point. Royal Bank, half point. Scotia's being a little bit more conservative. And TD a half point as well. So that means that we will see anywhere from another half to 0.75% in rate cuts in the prime rate, or the overnight rate and the prime rate, by the end of this year. Even if we look on the Bank of Canada website, we're even calling for cuts on there as well. So this is the market participants report. We're currently at 2.75 March, and they're anticipating, even the Bank of Canada and the market participants, which consists of 30 plus economists across Canada, are calling for the Bank of Canada to drop the rate further. So what about fixed rates? Now, when we look at fixed rates, way back here, May of last year, the bond yields were up around 4.13%. That means that fixed rates were anywhere between 5.75 and 6.5%. So there's a lot of people that sign mortgages here. And now we're sitting at fixed rates being down anywhere around 4 to 4.5%, really depending on the mortgage amount, whether it's insured, uninsurable. There's lots of different factors at play in that pricing. I'll get to more on these people here that sign mortgage rates at higher rates in just a moment. We look at the inflation rate. It's sitting very level, but the one challenge that we may have here is that as the tariffs come in, it could push up inflation. So we have to be careful. We have to continue to watch that. The unemployment rate is still sitting pretty high at this point in time, and that may push up further if there's layoffs and the labor market is really feeling a lot of pain from the tariffs. So what are we discussing with our clients at this point? We're looking at either, when we have clients, we're looking at either a 3-year fixed or a 5-year variable. Now, there's strategies in both of these situations. So when we look at a 3-year fixed, and I'm just using TD and Scotiabank, and I'm using just an average rate of 4.39, I'm using a variable rate of prime less a half, just for comparison purposes. So when we look at this over the next 3 years, and we compare 4.39 to 4.45, it's almost in a way breaking even. This is about $871. Now, I've used a 3 here because what I don't want to do is commit too long at this point in time. A 4 and 5 year may be too long to commit to at this point. Maybe when the rates begin to fall further, then you take a longer term rate to protect yourself against inflation in the future. A 1 and 2 year rate is pretty much the same, or getting very similar to what a variable would be. And the variable has pros and cons, so does the fixed. So at this point in time, if we compare a 4.39 to 4.45 over the next 3 years, we know it's about $871 higher for a variable. But if we factor in some rate cuts in here, and we call for this rate cut has happened, and we call for another rate cut in July and another one in December, if we factor that in, it begins to change the game. A big difference. If we compare that even over 2 years, then we're still sitting with quite a savings. So right now what we're anticipating, what we're discussing with clients is you can take a fixed or a variable. If you take a variable, then what you can do is ride the prime rate down. So you can ride the prime rate down, and then you can also enjoy lower payments along the way as well if you have an adjustable rate mortgage. Then at one point, as the bond yields drop and the fixed rates begin to settle, and ideally they will settle below 4% at some point, then you can lock in at that point. So those are two options in the market right now. Now, back to these people or consumers or mortgage holders that have their rates that signed contracts back here. They all have anywhere between 18 to 24 months remaining in their term. So what options they have for that is that they can actually refinance from, say, 6.35% down to, say, I'm just using a rate of 4.45%, and they can save a lot of money over the next 24 months. So that being said, is that it would drop payments, their balance would be lower, and they'd save a total of about $10,000. This is based on 635 to 445. So these, if you're out there, call us and we can run a scenario for you to see what makes sense. And even coming up for renewal, do you take a fixed? Do you take a variable? All these things play a role in strategically placing your mortgage over the next little while. So if you have any questions, please let me know. That's an update for now. Keep well, and I hope the weather begins to change very soon because this rain and cold is getting old. Keep well, and we'll chat with you again very soon. Bye for now.